Hello everyone, I'm Naval Tiwari from OBG Outsourcing. If your business sells products or taxable services into multiple US states, sales tax can become complicated very quickly. You may sell through Shopify, Amazon, Walmart, your own invoices, or several payment processors. The challenge is not simply filing a return. The real challenge is making sure your sales report, bookkeeping, tax collected, marketplace activities, return file, and payments all agree. In this video, I will show a practical monthly control system for 2026 with simple examples you can use in your own finance process. Before we begin, if you find practical accounting and tax control content useful, please like this video, subscribe the OBG Outsourcing channel, and follow us for more updates. Multi-state sales tax is really a data control problem. One sale can appear in your online store, your marketplace report, your payment processor, your accounting system, your sales tax software, and your bank. If those systems are not reconciled, the return can be wrong, even each individual system looks reasonable. A useful question for every finance manager is, can I trace the number of the state return back to transaction level sales and then back to the books? If not, the process is to depend on assumptions. The first control is understanding why the business may have an obligation. Sales tax nexus can arise from physical activity, economic activity, or practical rules. Physical nexus may involve employees, inventory, an office, warehouse, or other in-state activity. Economic nexus depends on state-specific thresholds and measurement rules. Marketplace facilitators rules can shift collection and remittance responsibility to the marketplace for qualifying marketplace sales. The key bookkeeping point is that all the categories must be monitored separately. State-specific rules can change, so always verify the current rule before registration or filing decisions. Here is a simple example of monthly Nexus monitor. Imagine the state A has reached 82% of a company's internal alert level. State B is at 54% and state C is at 31%. These percentages are not legal thresholds. They are simply an internal monitoring example. At 80%, the finance team can flag the state for review. That creates time to verify the actual state rule determined by the marketplace sales are included or excluded for that test, review the relevant look-back period, and prepare registration if required. Identify the risk before filing obligation become overdue. Your chart of account should make sales tax easy to prove. Revenue should distinguish direct taxable sale, exempt or non-taxable sales, and marketplace sale where useful. The liability structure should allow the team to identify what is payable and to which state. For example, if book shows one combined sales tax liability of $50,000 across 10 states, the reviewer has much more work. If the supporting schedule clearly shows the balance by state, the return to ledger reconciliation become much faster. Refunds, discounts, shipping, credit, and exemption should also be separately identifiable when they affect the tax calculation. The goal is simple: better account structure, faster review, and a stronger audit trail. Let's use a simple channel example. Assume monthly net sales are $115,000. $35,000 came through a marketplace, $80,000 came through company's direct store. For market portion, the platform may be responsible for collecting and remitting tax under applicable marketplace rule. For the direct portion, the company may have its own collection responsibility where it is registered and the transaction is taxable. Bookkeeping must keep these channels separate so the tax collected by the marketplace is not accidentally added to company's own payable balance. This is one of the most common reasons a sales tax payable account becomes overstated. A common mistake is preparing the sales tax return from bank deposits. Consider this example. Gross sales are $120,000. Refund are $5,000. So net sales are $115,000. But the bank deposit may be lower because payment processing fees, reverses, chargebacks, or time difference are deducted. If you start from the bank, you can understate sales or misclassify fees. The correct workflow is to start from transaction level sales, reconcile those sales to the accounting system, prepare the sales tax report, and then reconcile payment processor settlement and bank deposit separately. The bank is a reconciliation point. It should not be primary sales tax source. Now let us look at the sales tax payable account. Assume the opening liability is $8,000. During the month, the business collected $12,000 of sales tax on transaction for which it is responsible. It then pays $10,500 to state authorities. The expected closing balance is $9,500 subject to timing and valid adjustment. If the ledger shows $20,000, instead, do not force a journal entry just to make it match. Investigate the reason. It may be missing payment, duplicated tax, marketplace tax included in the company liability, a prior period item, or a posting error. The best reconciliation explanation the difference. It does not hide the difference. A calendar is another basic but powerful control. Each registered state may have different filing frequency and due date. Your trackers should show the state, registration status, filing frequency, due date, preparer, reviewer, return status, payment status, and confirmation number. For example, suppose the team has 5 returns due in 1 week. A status dashboard can immediately show 3 filed, 1 under review, and 1 waiting for client information. That is much safer than relying on email reminder or memory. And while we are halfway of this video, if you are finding this practical, please like the video, subscribe the OBJ Outsourcing, and follow us for more accounting and tax updates. At month end, the reviewer should be able to recreate the file written from books without guessing. The close package should include sales by state, tax collected, exempt sale, marketplace sale, refund and credit, shipping treatment where relevant file returns, payment confirmation, and the sales tax liability reconciliation. A strong control is to pick one state each month and perform a complete proof sales report to return to payment, and payment back to the liability account. If you cannot recreate the return without guessing, the process needs improvement. Automation can reduce repetitive work, but it should not replace review. Sales platform and tax engines can collect data, accounting integration can post entries, AI can flag exceptions such as missing state, unusual tax rate, negative liability, late filing, or channel mismatch. For example, if a state normally shows a positive payable balance but suddenly turns negative, the review system should flag it instead of silently accepting it. Technology should help the accountant focus on exceptions, investigation, and professional judgment. The goal is controlled automation, not blind automation. These are warning signs that your sales tax book may need cleanup. The sales tax payable balance keeps growing. The liability becomes negative without a clear reason. Marketplace sales are included in direct filings. Exempt sales do not have supporting certificates. Sales tax payments are posted as exempt expense instead of reducing the liability, or return are prepared from bank deposit rather than sales data. If you see 2 or 3 of these warning signs together, the issue is usually not one transaction. It is a process control problem. That is the right time to clean up the workflow before exposure becomes larger. At OBG Outsourcing, we help businesses create a controlled monthly sales tax bookkeeping process. Our support can include multi-state sales tax bookkeeping, Nexus and threshold monitoring, sales channel reconciliation, sales tax payable reconciliation, filing support, and audit-ready documentation. Our objective is not simply to prepare another report, it is to make the number traceable, reviewable, and easy for management, CPAs, and tax team to rely on. Clean books should make tax reporting easier, not harder. Here is the 2026 action plan. First, list all sales state where you sell and all state where you are already registered. Second, reconcile each sale channel separately. Third, monitor Nexus monthly using state-specific rule. Fourth, reconcile the sales tax payable account every month. Fifth, review exemptions, product taxability, filing frequencies, and process exceptional periodically. If your sales tax books are difficult to control, OBG Outsourcing can help review your current process and build a cleaner monthly workflow. In this video helped you, please like it, subscribe to OBG Outsourcing channel, share it with your another business owner and finance manager, and follow us for more accounting, bookkeeping, automation, and tax update. Thank you for watching. I am Naval Tiwari from OBG Outsourcing, and I